All right, we're gonna get started. I'm gonna give him, he hasn't joined yet, but I'm just gonna give a quick intro before he jumps on. So many of you probably are already familiar with a company called First Trust. We've used First Trust investments for a number of years. They are a leader in actively managed exchange traded funds, and they've got one of the largest menus of those. Some of the investments that you probably have heard us talk about quite a bit is buffer ETFs. So they have an ETF, it's the symbol is BUFR, and basically what it is, it invests in the S&P 500, but they write options against it to give you downside protection of roughly 10%. So it has a similar risk profile as a 60/40 stock bond portfolio, but without the bonds. They use the options to hedge that downside. Also, another one that's really popular, and this one's actually been around since 2011. The symbol on this is FTHI. The HI stands for high income. It's the First Trust Buy Right income ETF, and the same thing. They use, they're investing in the S&P 500, but then they write call options against it to generate income, and it's currently yielding 8.59%. And there he is, 8.59%, and it's been around since 2014. So that's a little bit of background in that regard. Alex Lakatos is he's the vice president at First Trust, and he is over the structured investments as well as target outcome ETFs. And one thing I will say is I've talked to Alex quite a bit about investments like this exact one, and also they've been doing structured notes, which are very similar to this, for a number of years. And he's truly an expert in that area. So please, if you have any questions on anything, please ask him. He is the expert in that field. I know quite a bit, and I can always get the answers, but he's a great resource for us. We are shooting for 30 minutes. Alex will probably be speaking for around 15 minutes or so, but if you have questions, please fire them as we go on, and we'll answer those at the end. I'll turn the time over to you, Alex. Thanks for being here.
Awesome. Thank you, Parker, and good afternoon, everybody. I apologize for had some technical difficulties. The laptop did not work. The iPad did not work. So I'm trying the cell phone. Parker, if you wouldn't mind, I did send you an email with the presentation deck itself that should be arriving shortly. But I appreciate the opportunity to join the call today. As Parker had mentioned, I work at a company called First Trust Portfolios, work very, very closely with the team and specialize in the options investing space. By and large, has been and continues to be our fastest growing line of products that we offer. And I'll touch on that briefly, but the demand that we have seen in recent months and the uptick of usage has led us to start creating the products that we're going to talk about today, the private funds and things of that nature. It's really the evolution of the options investing space, right? If we think back to 10, 15 years ago, you had advisors with risk management tools at their disposal, like using puts, right? We own a stock or we own a mutual fund and we want to protect it. How we've seen that evolve is bringing these to more retail friendly products and opening up access. And so what I am excited to talk today about is the FTVest private fund. Parker, and please just let me know if that didn't make its way through the firewall.
I'm not seeing it yet.
Yeah.
I'm just looking. I have the old PDF.
Perfect. And it makes for bad radio, so I apologize. I just can't show on my screen, but I'd like to just start with kind of the construction of the product. So the vehicle itself is a private fund. It's 40 Act registered with the SEC, but it is a two-year term. And that, to me, I always like to address on the front end really what we need to be cognizant of as investors. And that is this truly is a 2-year lockup period. But this product itself is an evolution of the buffered ETFs that many of you own in your portfolios that Parker utilizes in his practice, and target income or covered call strategies. So let's start with the fund construction itself. This is a 2-year product. The product is comprised of 101 stocks. The name of those stocks, it's an index, it's an ETF, is the S&P 500 Focused 100. These are 100 stocks that are meant to mimic or track the performance of the S&P 500. We can go back over any particular time period we'd be interested in, 1 month, 3 month, 1 year, 3 year, 5 year, and look at the correlation or the behavior of our index and compare it to the S&P 500. That correlation is virtually 1-to-1. It's 0.998. So we have 100 stocks, 101 that are meant to, that is our base, right? That is our stock basket. That is going to drive performance. When we think about the benefits of a strategy like this, particularly in a strategy meant to generate healthy levels of income, really that's where our edge comes into play. So we are going to utilize options. We are going to write options on a weekly basis on all 100 of those stocks. So by design, a 2-year product, the target yield or what we are seeking to accomplish or generate for you as the investor is 15% a year in income net of fees. Now, how do we generate you 15% a year in income? Let's use Tesla as an example. Tesla is one of the 100 names in the portfolio. I own 100 shares. Let's just make it easy. On a weekly basis, we sit down as a team and say, how many of these shares of Tesla do we need to cover? Let's make, for example's sake, let's say I'm covering 20 shares of Tesla using a covered call or an at the money call. That allows the other 80 stocks to go long or remain long, where we get to participate in the stock's upside or capital appreciation. But that's an exercise we do with all 100 names we own. We are going to sit down and say, how many stocks do I need to write on in order to generate you this target yield? We do that this week. We do the exercise again next week. Let's say stocks where volatility is up, interest rates have gone down, or vice versa. That maybe next week I'm covering 22 of those Tesla shares, right? What doesn't fluctuate or what doesn't change month over month is your income or is your distribution. The only thing that is going to vary week by week, month by month, is the percentage or the shares that are covered, and I'll touch on that briefly as well. So we have our equity component. Let's see, it's loading right now.
So hey, Alex, just real quick. This is an old one. I don't know if this helps you at all. The one that you sent didn't come through.
Oh, that's okay. So if you would please, if we could go to slide 5, we keep going. Let's go. Yep. So if you bounce back just briefly, just to revisit that equity exposure or the stocks that we are investing in, right? That is the description of the investable universe. So we start with the S&P 500. We add screens. That's what gets us to those 100 or the S&P 500 Focused 100. Parker, if you wouldn't mind bouncing, I believe it's 2 more slides to touch on. Yeah, well, perfect.
Right here?
Yeah, that's great. So we have our stock basket. We have our income writing process. We think about the benefits of a fund like this. It's that attractive defined levels of income, but also the usage of options to protect or preserve principal. So what we are doing when this fund trades, we bring these to market on a quarterly basis, is we are also buying a 2-year put that is written or protecting us at the end of this product's life cycle. So we are buying you a 2-year at the money put on the S&P 500 that is designed to act as a ballast or as an anchor to reduce volatility and also make sure that we're defining protection levels at maturity. So we think about this very simply. Our stock basket is the S&P 500 Focused 100. We're buying you a put on the S&P 500. 2 years from now, at maturity, we are entitled to that protection. And so in a world and we just have not experienced this recently, but let's say 2 years from now, the S&P 500 was to be down 7%, hypothetically. And our stock basket, which is meant to track the performance of the S&P 500, varied slightly and was down 8%. So the S&P 500 is down 7, our stock basket is down 8. We would be down 1% at maturity. Now, keep in mind, along the way, we have been making 15% a year in income. But that is also something that we want to be cognizant of, is our protection is on the 500, our stock basket is on the 100. There could be a slight amount of slippage, but again, contractual protection at maturity. This series that we are talking about today, that's going live in the end of December, beginning of January, this will be our 8th vintage that we've brought to market. We are now on series 8, right, or B4. The good thing is that these products have been live for 2 years now, and so we have real world data to support, especially think back to April of this year, right? We had the Liberation Day drawdown. I know it feels like it's been a really, really great year for the markets, and it certainly has. But remind ourselves, back in March, depending on where we were consuming our news from, the world was ending, right? The S&P was down 19%. Tariffs were going to bring us to our knees. The US dollar was no longer going to be the world's standard. But we had this product live, and back in the month of April, when the S&P drew down 14% in 5 trading days, because we had that defined level of protection, the fund itself was down roughly 2.5%. So again, that put acts as a ballast, acts as a stabilizer for the value that we see on our statements. But said very simply, just to recap, right, some of the fund highlights: this is a 2-year product. The benefits of owning something like this, by and large, number one benefit is that attractive level of income. We are doing the heavy lifting for you on a weekly basis. We are writing those calls. That is not going to fluctuate week over week, month over month, year over year. We are picking up defined protection at maturity. And then finally, there is the possibility of capital appreciation on the back end. And I bring that up as the distant third, just to set expectations. With this 2-year product, we also anticipate on a weekly basis capturing between 40 and 50% of what the S&P does to the upside. So in a world where the market averages 10% per annum for the next 2 years, we can anticipate capturing about 8%, right? Or trading from 100 to 108. Keeping in mind, we've also made 15% for each of those 2 years along the way. So defined levels of income, defined levels of protection, and then finally, the possibility to capture market upside or see capital appreciation are really the 3 cornerstones to a fund like this. Taking a step back, and we can certainly open it up to questions. The primary pushback that I'll predominantly get is, this sounds too good to be true, right? Why have I not heard of a strategy like this? Why is everybody not utilizing something like this already? There are some challenges, right? As I mentioned, this is the brainchild, or has evolved from, decades of options-based strategies evolving over time. But really, it's been the technological advancements that have made this possible. So there is a lot of coding that goes into writing all of those weekly options. That just hasn't been a possibility. But the other thing to be cognizant of is, because there is a 2-year commitment, because we don't constantly as portfolio managers need to create or redeem shares, and we have money leaving the fund or money entering the fund, it allows us to pull these 3 different levers. The final real hurdle, right, is this is available for accredited investors only, and will trade. The initial or minimum investment is $25,000. But outside of that, we do have a ton of conviction in the concept. With markets, we've now Just this year alone, the S&P has eclipsed its 44th all-time high. If we are looking for ways to keep consistent levels of income, stay invested in the markets, but also mitigate volatility for the next couple of years, this is where we think it makes a ton of sense in portfolios.
That's good. I'm going to see if we have any questions. If not, I've got a couple.
Totally. And I again, I can't apologize enough for the technical difficulties in making you bounce back and forth with
no, that is fine. And let me find this here. Let's see. I don't see any open questions, you guys. So okay, I'll just ask some questions and we'll see if any pop in here. So Alex, as far as the income goes,
yes,
how does that pay out?
Yes, so that is paid out on a monthly cadence. The income itself is.
Okay. And tell us, how is this taxed?
Yes, so that
for a non-retirement account, how's it taxed?
Yeah, that will be taxed as ordinary income or interest income.
Okay, yep. So no K-1 distributions is 1099?
Correct. 1099, this will sit, if we think about our accounts themselves, this will sit amongst consolidated 1099. This will just look on our statements like a mutual fund.
Okay. And so I know I'm familiar with, you guys have been doing structured notes, which are smaller, similar things that you're doing here. In regard to that 2-year commitment, so liquidity, not liquid for 2 years, correct?
So there is a provision. What happens, we will, with the 2-year product, if there is a need for liquidity, 30 days before the 1-year anniversary, you can contact us and you do have access. At the 1-year mark, there will just be a 2% penalty for early withdrawal.
Okay.
Now, as we think about these products now into year 2 for us, and we will have some of the older series turning over, at the 2-year mark, you will get notified 30 days ahead of maturity, and you have the ability to either roll the proceeds and say, we were happy with this experience, let's just do it again, or you can notify us and elect to take cash or have your principal redelivered to you at maturity.
Okay, good. And it's, so for a lot of our investors, this would be obviously for a lot of them are retired.
Yep.
They're looking for income generating investments. What's best practice as far as what are you seeing as far as a portion of a portfolio, an income portfolio, say a 60-40 stock bond mix? What are you seeing, or what's a suitable percentage that you've been seeing for this type of investment?
Totally. Yeah. And not to, it obviously is going to depend on everybody's risk tolerance,
Sure.
Lifestyle goals, everything like that. The beauty of something like this relative to other covered call strategies or income producing vehicles that, you know, we're taking on additional risks buying some fixed income securities, right? Credit risk, duration risk, interest rate risk, right? My income could fluctuate month over month with some of these other vehicles, depending on what happens with volatility or what happens with interest rates. For us, being able to define that consistent level of income, we do think it makes sense using the traditional 60-40 portfolio. Of that 40, you know, maybe 20 to 25% of the 40 from the 60. Certainly, this is not meant to be anybody's only investment that they hold in retirement. Definitely attractive levels of income, defined levels of protection, but this is meant to complement what you guys are already doing. And we think about for those folks in retirement that have had tremendous success, are looking to protect what you guys have built. Really, this is a vehicle that we can add to complement what you've already been doing to reduce risk.
Okay, great. Thank you for that. We are getting some questions. By the way, you can't speak on the, we won't be able to hear you. It's ask questions, but just if you have questions, just put them in the chat, and then we'll address them there. So I have a question in regard to basically the capital appreciation. So he mentioned he gets the hedging on the downside part,
yep,
and the 15% income part, but just maybe touch one more time on the potential for capital appreciation.
Totally, 100%. It's a great question. So we think about our starting point on a weekly basis, and I'll stick to I own 100 shares of Tesla. I'll use that example. Income solution first. So I'm going on a weekly basis to determine how many of those 100 shares I have to cover to generate you that 15% a year income level. Covered call strategies by nature are going to reduce our upside because we are selling away that future upside potential to generate that income. The capital appreciation component is going to come into play with this strategy. And while we will comfortably quote about 40% of the weekly upside at maturity, because let's assume I cover 40 of the 100 calls of Tesla. Tesla stock goes up this week, right? It started at 100, but it came back. It was up 4%. It was a good week. Now those shares that I wrote at the money calls on, so those 40, I have to now go rebuy those at the market at the prevailing market price. So let's say it went up to 104. I've got to go buy 40 shares at 104. And so that can reduce or mitigate some of our upside capital appreciation potential. And so just as a standard, we look at the overwrite for the strategy, or how many of the stocks are we covering consistently week over week, month over month. Leaving 60 shares of Tesla long, covering 40, allows us to participate in what Tesla stock is doing week to week, but just not fully, because we are covering a portion of those shares.
Okay. And then the downside protection's coming in with the put.
With the put. And to kind of tie a bow on the downside protection component, right? We are buying you a 2-year put on the S&P 500. We own the S&P 500 100. So there could be some slippage. Again, historically, the correlation between those two is virtually 1-to-1. But in a world where the S&P 500 is down 7 and we were down 8%, as investors, we would be down that 1%.
Okay.
But it collected that income for the last 2 years.
All right. Perfect. So I have a question, because I agree that the 15% is eye-popping, and it definitely caught a lot of people's eyes. So thank you all for attending. So like your liquid ETF, like FTHI, it's yielding similar. It's invested in the S&P 500, and then you're writing covered calls against it. It's about 8.5%.
Yep.
So what's the mechanism to basically boost that up to 15%?
Yeah, that's a great question, right? Or even there's a lot of covered call ETFs or funds in the space that don't generate the level of income. The difference is we're writing weekly at the money calls on individual securities. So we think about a product like FTHI or some of these other vehicles that are writing call options, whether they are weeklies, monthlies, yearlies, but they're writing on indexes. They're not writing on 101 individual securities.
Perfect. Okay, that makes sense. Great. As far, and it says new vintages, like that's quarterly, right? So every quarter those are coming out. So for some of you who maybe aren't ready now, but retiring like you, Dave, that would be available for you in 2026. What about fund expenses?
Yes. So the internal expense ratio for this fund, being a private vehicle, is 2.85%. But it is a good question. The 15% income number I keep quoting is actually net of fees or after those fees. So what we are actually doing on a weekly basis is we're writing enough calls to basically generate 18% a year in income. And that additional income is being used to offset that fee that's being paid by the client. So 15% a year net of income.
Okay, good.
Or net of fees, sorry.
Good. Any other questions? Fire them away. I think we're about there. I have one last one.
Sure.
Just so I know somebody else there has this question. So worst case scenario, what if the market's down 50%, et cetera, what's kind of worst case scenario for an investment like this?
Yeah. It's almost counterintuitive. Worst case scenario, owning this fund is the markets do 30% a year. And because we are limiting your upside as investors with the emphasis of generating that income, if the markets do 30% a year for the next 2 years, certainly you have other investments that are participating alongside that. we're still making our 15% a year in income. This looks great, but we are not participating in nearly, if not almost 60% of that market upside. In a down market or in a flat market, this is going to look like one of the best vehicles that we own, one of the best products that we have. Because again, in a world where 2 years from now the S&P is down 50, we have a put. We have guaranteed contractual protection that is going to get us back to par at maturity or back to that initial commitment. Now, the one thing that I will touch on, which if we do have clients who have experience owning structured notes or things of that nature, is that 15% number is based on the fund's value or the fund's NAV. So the series that are out there currently with the markets being up, because we write these calls on a weekly basis, we are writing, let's say the fund is trading at 101. We're making 15% of 101, right? If the fund is trading at 103, we are making 15% of 103. To your point, let's take a look at the exact opposite scenario where the market is down 19% like we saw to begin the year in April. Yes, granted, the fund was only down roughly 2.5%, but during that time period, we were making 15% of 97 cents on the dollar. So we never anticipate trading in a down market 1-to-1 over the course of those 2 years because we have that defined level of protection. But that is something to consider as we generate that income. Although consistent, it will be based off the fund's value.
Okay, that's helpful. One thing, and this is just from my viewpoint, because there's been similar investments like this, even like on the target, the monthly target outcome ETFs, like the 1 year on, say, August. So just to set expectations for you all, Alex mentioned like in April when we had the drawdown around tariffs and everything else, the stock market sold off heavily. Those puts would give us some protection to the downside. But my understanding, Alex, and correct me if I'm wrong, is as you get closer to that 2 year maturity, it's going to be closer and give more protection. So if you were to invest in this in December and say January, we were to have a 10% correction, it will give you some cushion on your Schwab statement, but not 1-to-1. As this thing gets closer to that 2 year maturity, then it's going to really tighten up and get closer to bringing that to gap closer. Is that correct?
Yeah, I think that's extremely fair to say, right? As we are buying this put to protect you at maturity, we do have the time value component that is going to come into play. Yes, I have defined protection 2 years from now, but 3 months in, 4 months in, there is a chance that if we are down 5-10%, that you do see your on your Schwab statement, right, a loss during that time period. And there is leading up to that maturity as that protection starts to come into play and actually a severance in, there's going to be a dislocation and correlation, right? Where you do see that true up period leading up to the end of the fund's life cycle.
Yeah. And that's important to think as, so we got to think of this as even though it has that put, we got to think of this as a 2-year maturity. And that's really at that end point is when we're going to have maximum coverage of principal. Okay, so you mentioned some historical data. We've seen them go full cycle. What was the yield over the last couple of years? Was it at 15% as well?
Yeah, the beauty of this is the terms are not going to change, right? So we'll have a lot of investors that like the idea, that are wanting to participate, but choose to ladder this. Meaning, what's nice is the quarter over quarter, year over year, your terms do not change. It's a 2-year product. It's always 15% a year in income. The only fluctuation, right, series over series, is just where vol is at and interest rates are at and what portion is being covered. But that's fluid throughout all 8 vintages that are live. So yes, very, very consistent. If we wanted to participate in January and then wait until the end of April, right, we're not going to be blindsided with the next product available is only yielding 10, for instance.
Okay, great. We got another one. So based on history of the other vintages, has the fund missed its target income And if so, why?
Yeah, great question. No, it has not. And the only reason, the one variable, right, that does not fluctuate, the income is consistent on a weekly basis. And it's not me. So you can sleep peacefully knowing I'm a guy doing a Zoom who can't figure out technology. It
Yeah.
is not me pulling the levers. The only thing that's going to vary week over week, right, is do I cover 40 shares of Tesla or 42 or 46? That overwrite percentage, or how many stocks we're covering, is the only fluctuation week over week. We are making sure that that target income level is not changing and is extremely consistent. And taking that one step further, because generally it's a question that follows this, is has there been an environment in which you guys have you had to cover all 100 shares for right, or have you experienced a return of capital? The answer to that is no. Right now we are able to generate 15% a year in income in this environment where vol has been very low, and right now the overwrite percentage or of the portfolio is roughly 30%, meaning on average 70 of those 100 shares of each are left to participate one-to-one with market upside.
Okay. Can you say, as far as anything that's gone full cycle, as far as what some of the appreciation has been? And I know that that sounds a bit hoggish, because 15% is fantastic, right? But just out of curiosity.
So we haven't had anything mature just yet, right?
Okay.
We started these to the market. We've got 4 vintages out there so far. So we are 1 year away from A1's life cycle rolling over.
Got ya.
If it would be helpful, what I can do is follow up with legacy vintages out there and the performance so far of all the individual series.
Okay.
And
well, that's Alex, it's been helpful. You rallied through difficulty. Fantastic.
I've got people at my house changing the blinds, so I'm in a random stairs through my office. I appreciate the time, everybody. Parker, thank you for all that you do. And if there's any follow-up, please let me know. And I'm happy to provide any resources that are requested.
Yeah. Thank you all for attending as well. And if you have any additional questions, feel free to reach out to the office. One last question, Alex. If they are interested, maybe just quickly describe the mechanics on how they would get invested into this.
Yep. So that's a great question. This is available at Schwab, Fidelity, at all major custodians. If you are interested, we will have a few deadlines. You would coordinate with Parker and the team, and they would actually be able to file the paperwork for you. And then it would simply be a form that was sent to you as the investor to sign. The signature deadline is going to be, or if we are interested, we need to be notified as First Trust by January 9th. We will do everything for you. We will put it on Schwab as an investment. And then depending on the commitment that if you're looking to trade, we do all that for you. And then 2 weeks after the trade date itself, you would see this on your Schwab statement alongside all your other investments. So really not a ton operationally different. The one thing to be cognizant of with private vehicles is there is a wire associated with it. But that would really be the only additional step. And we will do the wiring for you.
Okay. That sounds good. We got there almost in 30 minutes. So thanks everyone for attending, and we know you're all busy. Please reach out to us with any questions. And Alex, again, thanks for your time. Have a great day.